Hey guys, we are live on LinkedIn and YouTube right now. My name is Walker Deibel. We are going to be jumping in and covering how to build a private market portfolio without being wrecked. Okay, so here's what we got today. Listen, we're going to go through what I call the 12-24 rule, all right, which is like how to build a private market investment portfolio with less risk and maximum returns. Okay. And so here we go. Let's see. I should have the chat up and going. If you guys wouldn't mind, drop something in the chat. Let's see, comments. Drop something in the chat so that I can see that we're here, so that I can see that this audience is going. All right, that'd be helpful. Type in where you're from. There we go. Thank you. All right, great. So we're live. All right, that's great. I appreciate it. Okay, guys, here we go. Here's what we're going to cover today. The 12-24 rule, how to build a private market investment portfolio with less risk and maximum returns. Okay, the 12-24 rule, all right, why most investors are over-diversified, why concentration builds wealth, and why the architecture of a 12-24 private market portfolio gets that balance of concentration and diversification exactly right. Thank you, near Atlanta. Love it. Listen, who's this for? Okay. I am known for buying businesses, right? And so there's a lot of people that might be tuned into this, like, coming in, looking for Walker, how do I buy companies? We're not going to be talking about that today. We're going to be talking about what I call fractional acquisitions, right? It's where I'm spending a lot of my own money and a lot of my own time investing at scale across the private markets. And so if you're an accredited investor, making 200,000 or more and have a net worth of $1 million or more, and you're wondering, how do I make my money work as hard as I do? This call is for you. Okay, this is the audience for what we do, at Build Wealth. Okay, so ultimately we've got all of these diversified portfolios, and we're all familiar with how that works. And so when we think about, applying this into the private markets and investing in syndications and stuff, how does this actually add up? How does this make sense, right? And when you take and the reason for this diversification at the end of the day is when you take all investments, all right, and you put them across a risk return profile, ultimately you scatter graph all of the investment opportunities out there, and it ends up looking kind of like this, right? You either have this, high risk, high return, your cousin is doing a, AI for engines startup, and, and you're the first money in and he doesn't have any customers. That's really high risk. But as long as the terms are right, if that works out, you're gonna make $1 billion, right? And on the other hand, you've got T-bills, which are really boring and, maybe keeping up with inflation at the most. And so you've got this low risk, but low return kind of result. And so what we're all looking for as investors, am I right, is this. How do you get that magical low risk, high return situation? And what are the levers that we have to pull in order to engineer this into our own lives, our own investments, and our own portfolios? Okay. If you don't know me, my name is Walker Deibel. This is the I'm cool slide. It's basically, I've been in every seat of a deal, right? I've bought multiple companies. I've sold multiple companies. I've been inside over 100 transactions. Okay. I was a partner firm with Quiet Light. I'm a founding shareholder at Dealonomy. I've been an adjunct professor where I launched the ETA program at the Olin School of Business. I've been considered a thought leader, and I've been featured in all these different places. And really, I'm most well known for the Wall Street Journal and USA Today best-selling book, Buy Then Build, which is all about why entrepreneurs should buy existing companies rather than starting from scratch. When this book came out, this idea was completely radical, completely new. Defined, if I don't mind, sounding egotistical, it defined the perspective that we all take today as entrepreneurs looking at buying existing companies. And I did it for over 10 years before I even started writing the book. Okay. Let's see, that led to, so today, what I do is I actually write also every single week, Wealth Stack Weekly. It comes out on Tuesday mornings. The last issue came out today. And it's the fastest growing alternative investing newsletter in the world. We launched it in May with exactly 0 subscribers, not even my mom. And this morning it went out to over 150,000 subscribers, which is incredibly flattering. But I spent a lot of time on this. I've got a team of researchers that I work with, and we, I just want throwing that out there. It's free. Feel free to sign up. We go through a lot of things. I also was the founder of Acquisition Lab, which is the elite accelerator for people looking to buy businesses, right? And we've got, our members have acquired over $1 billion in small business acquisitions. And the reason why it sort of went this way was because this is how I found success, right? I found success by being an entrepreneur and being an investor together in what I called acquisition entrepreneurship. And I did this a multiple of times over a decade, right? And I bought a number of companies, and I owned and operated them, and ultimately, wrote the book, created the accelerator, all the rest of it. And so this is how I found success. But the thing was that, as I started buying more and more companies, it was awesome. But like building this portfolio had this constraint, and that constraint was me, right? I was the constraint. I couldn't be everywhere at once. And so ultimately, high earners, business owners, entrepreneurs, and high earners that are out there you have more at risk than you even realize, okay? If you're employed, that's a centralized risk. You're just hoping, really that like your employer doesn't lay you off or fire you one day. If you are an entrepreneur and you've got, one business, your business is concentrated. If you've got a diversified portfolio, I hate to tell you, but all of those investments are correlated, right? And so that's what's happening today. And so we're all sitting there, with the 7 stocks that are creating the whole entire stock market, and they're feeling a little flimsy at the moment, right? We're seeing a lot of billionaires exiting stage left with a lot of their holdings, and we're sitting there wondering what's going on. Maybe we work in tech, and our job that was so safe for over a decade is maybe a little flimsy. So how do we ultimately take control and get this balance right, And so how do we multiply ourselves is ultimately like the question that I had. Like if I'm the constraint, how do I multiply myself? And the way I got there was by saying, look, if I invest in other entrepreneurs doing other entrepreneurial activities in industries with a supply-demand imbalance, with a playbook that they've done before, and they're great operators, great sponsors, great opportunities, then these are the ways that I'm kind of thinking about doing it. And so ultimately, I was able to invest in a number of different entrepreneurs, and I'm using that term slightly religiously in this, or slightly flexibly in this description here, but we'll get to that in a minute. But ultimately making fractional acquisitions, backing other teams in markets I wasn't playing in, was how this started going on. And ultimately, I called it the pizza by the slice. So when I buy entire companies, I talk about buying the whole entire pizza all at once. You have responsibility for the pizza, you have the upside of the pizza, you have the personal guarantee on the pizza, and you've got to eat this whole pizza at once. You've got to manage everyone at the table, all the things. Sometimes I just want to eat dinner. Okay, I don't want to be making the whole pizza and doing all the dishes and doing all the stuff and taking all the responsibility. Sometimes it's like, this is the person that can, build this cheese pizza or whatever it is. And look, as much as I'd love to say that I made this up, we all are familiar with Rich Dad, Poor Dad and the 4-quadrant cash flow model. And ultimately, it's all about getting to the right side, right? It's be a business owner and be an investor. I mean, ultimately, that's what we're all trying to do. That's where we're going to get the freedom to be where we want to be, okay? Ultimately, it's capitalizing on the inefficiencies found in the private market is the little thing that makes the big difference with entrepreneurs. It's the thing that allows them to achieve outsized gains by committing to that task, right? And so this is kind of where I'm looking for these investments, and where can we find them? In alternative investments, okay? So when I say entrepreneur, I might need someone, running a real estate development company. I might mean a sponsor of a private equity. I might mean an operator of a private company. I might mean a portfolio of real estate collateralized backed private credit or something along these lines. So it's these alternatives that I'm looking for. Ultimately, I built a pizza portfolio, and I did so by, for the first 10 or 12 years, I was buying my own companies. And so ultimately, I started to say, as I'm making these investments, I'm going to make an equal investment in them as I am in my own acquisitions, right? So just to get very, very specific, you're talking about, when I buy a company, it's going to cost me, I'm going to invest probably between $100,000 and $250,000 or so, right? So somewhere in there was how I got started and how I started thinking about, expanding into these markets. And as I started to think to myself, Walker, how on earth do you think about allocating in the private market? Well, when I think about buying businesses, right, and I think about real estate, and I think about even deal making in terms of doing deals and getting it done, there's always this concept called the capital stack, and I think we're all familiar with it if you're on this, if you're watching. But ultimately, it's the concept of you've got the senior debt, okay, that's the first out, they're senior secured. They have all the collateral, they get all the first money, they get paid every single month, and all the way at the top is the common equity, right? The entrepreneur that gets all the upside, as long as everyone else gets sort of paid off first. And so when you think about, the bank is making maximum income off of the asset and their maximum collateralization, whereas the common equity has maximum appreciation ability, but it's the higher risk because they're in the last position. And so when I started, thinking to myself, well, when I look at private credit and I look at real estate and I look at private equity, these kind of parallel, they're analogous to the different levels of the capitalist stack, right? And so I came up with this model here that I call the wealth stack. And the concept is that, like, just like how we were trained to go out and get a job and take whatever 10 or 20% of that income that we're making and invest it in the stock market, okay? Maybe you're working at a publicly traded company and you're saving in publicly traded companies. This is the private market parallel. When you buy a small business, you are buying a privately held company that you own, okay? And what I'm proposing is that rather than building a holding company where all of a sudden you're responsible for all of these different companies, instead the single fastest, best way to build a diversified portfolio with competent teams already in place is by betting on those CEOs and those operators running those playbooks. And that's where the wealth stack comes in, okay? So listen, I need to pause for a second and throw a little disclaimer out. This is for educational purposes only. I can't give financial advice. I might say things that are directionally accurate, but not accurate at all. I've never seen a pro forma in my life that is correct. It's always off by 1 penny or more, usually a lot more. So I'm going to say things that are future forward and all the rest of it. And, all these things, like, be an adult. I'm not here to tell you how to invest your money. All investing is very risky. Now, here's the deal. First challenge. Okay, I've decided I want to invest in the private markets. Okay. Challenge number 1 is access. Okay. And what I mean by that is that, private investments were always something that were reserved for ultra high net worth individuals. And what that's defined as is someone with $30 million or more. Okay. And so if you're on this call, right, the odds that you have $30 million or more is, I think I can tell you, there's a 99.7% chance you do not have that much money. In fact, I think I'm a little low. And so the odds that you have that much money are very slim. This was like all things. You go back and look at how banking started. They were targeted towards rich people. You look how, RIAs started. They're targeted towards rich people. You look how, these people with the private investments were first going out to market. They're going after rich people. This is where the money is, right? And so ultimately getting access to these deals is the first and hardest part. But because of the Jobs Act, I've been able to bring deals out that I'm investing in, that I'm vetting, that I'm doing diligence on, that I'm working, specific structures for our investors on, and we're investing together. We're building a family office as a community, so to speak. And so, getting access in terms of mostly syndications and funds has been dropping down to normal, everyday accredited investors. Okay, what we might call the normal, everyday millionaire, someone with $1 to $5 million in net worth, who makes money. And the reason for that is because it's regulated. Okay, it's regulated. So getting access is step 1. Now, once you solve for access, okay, whether it be private equity, real estate, or anything else, the second challenge is the minimum investment size, right? So if we've raised about a little over $30 million in the last 16 months, which is amazing. And so it's one of these where, our minimum investment in all of our funds is $50,000. And I try to do that because I want it to be very, very approachable for people. But at the same time, even $50,000 is a lot of money. Myself and other investors might be putting in hundreds of thousands in each one of these deals. And so it's like, no matter what the size is, there's nothing small. There's nothing de minimis about 50 grand. It's a lot of money, especially because it's like after tax, right? And so you've got this investment size. And so even just making a $50,000 investment in one deal, okay, this is a very committed decision. And it comes with high risk. Like, this is your money that you earn. This is your family's money. And all of a sudden, you really need to figure out, how this is going to go down, okay? This gentleman, okay, is named Harry Marowitz. And he's important because he actually won the Nobel Prize in 1990, okay? And he won this Nobel Prize for this idea that he came out with called modern portfolio theory, okay? Modern portfolio theory is summarized like this. Correlation is the real risk engine. Diversification reduces the portfolio variance, and a portfolio can deliver smoother returns than any individual asset. What he's saying is, if you buy one stock, okay, that's really risky because that stock could go down. It might go up, sure, but it could go down. And so ultimately, if we're trying to, build the textbook for de-risking assets, the thing that we're doing here is we're building a diversified, non-correlated portfolio, because by having non-correlated assets, we're actually diversifying the returns. And so as one or three go down, most of them go up, and they're not correlated together. And so they sort of like ebb and flow in different directions. And over time, they all compound directionally the right way. This was the brilliant idea that this guy came up with. And it makes a lot of sense because the math that builds wealth is really just in compounding returns, right? So as long as we continue to compound, and as long as we continue to not lose money, having a portfolio of these things is the thing that actually, brings them together and creates this exponential line that we all kind of hope for. Because every time you look at one of these graphs, if you're talking to a stockbroker, a wealth advisor, or just reading a textbook trying to get smart about money, they always look like this. They always look, linear. It's like there's no variance. And the only way that you're going to get that, right, is through a diversified portfolio. And because of this brilliant modern portfolio theory idea, that's why everyone's portfolios look like this today. There's one problem with it, okay? There's one problem with it. And that's that the catch is it assumes you're not an operator, an owner, an entrepreneur. More importantly, you have no edge. You can't change the underlying asset. You can't add value. And you're really a price taker in an efficient market, okay? If you believe in efficient markets like the stock market, you think that like, hey, there's not really $10 on the ground there because someone would have grabbed it if it was a real $10, right? And so ultimately, this is why the academic frameworks push this diversification so hard, is because they're designed for passive public market investors, okay? I want you to think about that. So it's ultimately all of this stuff about modern portfolio theory is ultimately geared towards people that have a job somewhere else, that are not concerned about, their stocks or whatever. They want to buy blue chips and chill out and just let things cruise and invest over time and compound with some acceptable volatility, okay, that your advisor will walk you through. That's what this is for. It's not for what I'm going to call true investors. So how do we think about this? I want to share another realization that's in contrast to the modern portfolio theory. This is a guy named Michael Kitces, and Michael Kitces is a financial advisor, okay? And he works at Buckingham Asset Management, which actually sold, so I need to brush up on who they sold to and what they're actually calling themselves now. They're right here in downtown Clayton, actually, or they were headquartered before they were bought out. Anyway, the point is this: Michael Kitces, he's got a blog that is really great. He kind of asked this question, like, how do wealthy people actually become wealthy? Because I am a portfolio manager and none of my clients, are becoming billionaires or whatever. So obviously it's not through, price cost averaging and monthly investments in the stock market. And so what he said was, the reality is that when you look at those who achieve the greatest wealth or have the greatest impact, okay, virtually none of them ever diversified. Truly, guys, so check it out. Kitces came up with this idea, and the idea was that there was redwoods, there was pear trees, and there was bushes, okay? The concept here is that, a plant has leaves because those leaves are what reach out to get, sunlight or whatever. And the bigger the tree or shrub or bush or redwood is, the higher it grows before it branches out, okay? So in other words, A bush kind of spreads out real fast, okay, and like doesn't grow very high at all. A redwood, on the other hand, grows really, really high before it starts to diversify out, and a pear tree is somewhere in the middle. Okay, they've got some growth, but then they diversify out, and so it's the minute they stop diversifying. Okay, sorry, it's the minute they start diversifying that they stop gaining growth. Okay, and start going for diversification of sunlight. And so what Kitces did was he paralleled redwoods to all of the billionaires. Okay, so Bill Gates, for example, even when they went public, he didn't sell any of his Microsoft. He was, from a financial advisor's point of view, he was way over concentrated, okay, in Microsoft, for example. And it wasn't until after he was a billionaire that he started to branch out. Kitces identified over and over and over again. That's how these billionaires became billionaires. And so the concept that Kitces was coming out with was, listen, maybe if you want to get rich, don't diversify at all. Actually stay ultra concentrated in one thing, okay? At least that's what these billionaires are doing. And of course, we learned from modern portfolio theory, that's risky as hell, right? But the takeaway here is that diversification, the point of diversification is really to minimize variance, okay? But it doesn't maximize wealth, which is what we've learned from Kitces here. But I'm going to pitch to you the anti-Kitces thesis, which is the core issue, okay, of Kitces research here is that diversified assets were limited to publicly traded, market efficient, correlated assets, right? So I love Jim Collins. I love Good to Great. It's like the best book ever. Second to Buy Then Build, of course. But the thing with that is it's non-repeatable because all of the data for Good to Great is available because they're publicly traded companies. And so there's so much data available out there. If you wanted to create the same exact book or a similar book on private markets, you simply can't do it because it's all privately held companies with bad or opaque data, I should say, right? Not readily available data. So if I have 23, PhDs on staff, it doesn't matter because I can't actually get the empirical evidence. I can't derive what the empirical evidence would suggest. And so what Kitces did was exactly the same thing. He went to where all the data was. How do these billionaires become billionaires? It wasn't, how do these, 300 people who have $100 million in the private markets, how did they actually generate it? Okay, that's a great book. If you want to write that, reach out to me. Let's get that done. But the point is that capitalizing on the inefficiencies found in the private market is what give concentrated entrepreneurs the ability to achieve outsized gains. In other words, even going back to Bill Gates, okay? Sure, he had control, he had belief, in Microsoft. And the fact was that he never felt he was concentrated because it was his company, right? It was the thing that he was running. And so like when you look at, how are these entrepreneurs actually gaining these billions of dollars? Is it technically over concentration, or is it the fact that they're capitalizing on the inefficiencies and spending all of their time and effort and expertise in a really good opportunity, right? That's how entrepreneurs get rich, and that's why rich entrepreneurs get really rich. Okay, now when we start to look at this, inefficient private market applied in real life, I'm going to share with you here Tiger 21. They just came out with their newest allocation actually yesterday, and private equity crept up to 28%. And just because it's top of mind, I'll share with you that Bitcoin actually went from 1% to 2%. So ultra high net worth individuals are actually increasing their Bitcoin by a multiple of 100%, which is interesting. But neither here nor there. The point is that when you look at Tiger 21, this is a group of individuals that look, I think you have to have 20 million in net worth to even apply. But rumor is that, it's closer to 50 or up if you're actually in the group. And the concept here is that 54%, okay, are of their portfolios are very clearly allocated in private equity and real estate. Okay. I'm going to argue that 8% down here in fixed income is private credit, but I can't confirm that just yet. I need to reach out to them and figure that out. And where are we, guys? We're down here, okay, in the 22% public equities, okay? I want you to understand 100%, okay, of your investment portfolio is here in what rich people are considering 22% of their portfolio, okay? And the reason is because all of these different assets are actually not correlated to each other. And a lot of them are focused on, real assets with great teams and operators. Okay. Now, look, I mean, was it just Tiger 21? No. Okay. David Swensen of the Yale Endowment Model, who basically, created this whole thing, ultimately had an amazing run at Yale Endowment. I don't have the numbers off the top of my head, but ultimately he ended up with 73% in alternative investments. And the little thing that unlocked it for him was he thought that after a certain amount, people really overvalued liquidity, because he didn't care. He didn't need access to, an extra $1 billion or whatever, because that needed to be working while he had his liquidity kind of accounted for over here. So ultimately, by favoring illiquidity in terms of outsized gains, he's potentially the greatest returns as an investor of all time. Okay. So the reason here, the deal is that private markets ultimately behave differently. Okay. There's low correlation to other assets, especially the stock market. My whatever $1 million real estate portfolio here in St. Louis, Missouri is not correlated to, what NVIDIA is doing. All of these people are still paying rent, every single month, right? Just one example, our Dallas manufacturing facility has nothing to do with our oil and gas portfolio. There's completely different things. And they're not susceptible to, consumer sentiment when headlines start flying that, Peter Thiel sold his NVIDIA. Like that's, these people don't care. My oil and gas portfolio doesn't impact them. It's just, did you drive to work today? Did you, use all those things that use petroleum? Yes, you did. Okay. Look, they're higher geometric returns because of the supply demand imbalance that's available to us. Okay. And these higher returns come from human skill, okay, operator quality, and deal structure. These are the things that I am looking for and engineer in every single one of the deals that I'm personally investing in. Okay. And you should too. And by the way, just to throw this out there, human skill, operator quality, and deal structure most of those are not applicable when you're buying a publicly traded company. Okay. That's a different talk. I'm not going to go into it. I'll let you think on it. But these are the things that make it more of, I'm investing in an entrepreneur. I'm investing in a supply demand imbalance. I'm investing in a playbook that's been run over. One of our current funds, the sponsor has been doing this for 4 decades, running the same exact playbook. And his average internal rate of return for LP investors is 50%, 50. Okay. Compare that to the stock market where, over decades, you're going to make 7%, and it's, it sounds attractive. Okay. Concentration maximizes long-term compounded returns, but diversification minimizes variance. So Walker, how do we make sense of this dichotomy as an investor? Like, wait, am I, do I pick that one thing with 50%, track record IRR and put 100% of, sell out of the stock market and put 100% over here? No. Okay. No, you shouldn't. That's a bad idea because, concentration is risky, right? And so we don't want to be doing that. So I am introducing the 12-24 rule. Now, this came out about 6 weeks ago in WealthStack Weekly. And one of the things that led to me exploring this was that, every single time I met with a wealth advisor, in my own stock portfolio, and, I even kind of did this myself when I was in that role. They always wanted like every single stock between 4 and 6% of the total stock market portfolio in my account. And it was like, well, okay, we're diversifying this much, but they wouldn't go lower and they wouldn't go higher. Higher meant it was an it was an oversized purchase in that portfolio, but going too small meant like when it pops, you're not going to really feel it, right? And so ultimately, I started to realize that they were kind of going plus or minus like 20 holdings in my account. Then I started to look at private equity firms. Okay. I'm not going to go through all the private equity firms. We talked about a couple examples in WealthStack Weekly, but ultimately I started looking at them and they were doing the same exact thing. Okay. And as we're looking at our own private equity fund that we're planning on launching in 2026, I'm using the 12-24 rule very specifically in terms of how we're placing our money and our investors' money into different middle market companies. Okay. And so the concept here, okay, is that this is the high conviction private portfolio framework. All right. I want you to target 12 to 24 distinct positions, which is enough to be diversified and few enough to capture real upside. Okay. So we had an investor in a deal who, asked if he could come in at like a really small amount because he didn't have a lot of cash at that time. It was fine. We let him. He was a repeat investor over multiple investments, and he came in at this is in a different company, not Build Wealth, but he came in at $10,000 or $20,000, and we had this absolutely amazing return. And when he got his money back, he didn't feel like it was a really big win, and it was because the dollars were still really small for him comparatively. So you kind of want to be making a sizable enough bet. When I was buying businesses, I was putting in 100 to 250,000. When I'm making these investments, I'm doing a similar allocation. Okay. And so that's where you get that sweet spot where risk and return meet. So you're getting these you're building a non-correlated portfolio in the private markets with outsized gains. Okay. And then as, maybe one goes down and two go up or whatever, but because they're not correlated over time, your money is actually compounding. Okay. And so here's a little graph that we put together for the newsletter. And you'll see that right here is where you've got, 12 holdings. But if you have less than 12 holdings, you're not really diversified at all. Like as you can see, like it comes down pretty drastically as you continue to add holdings. But then once you get over 24, you've hit the point of diminishing returns. There's no point in having, 30 or 50. Or, if you have, that many or 100, all of a sudden you have a mutual fund and you can't feel your returns. Like when one of your investments is a rock star investment, you can't feel it anymore because you're so diversified that the impact of any one holding doesn't actually impact anything. Okay. So you're back to that diversification eliminates variance, whereas sorry, I just got a text on this call. So anyway, so if you're less than 12, you need more to add that diversification protection, but still feel the concentration rewards. Whereas, under more than 24, you're starting to like be a mutual fund. So right in that 12 to 24 pocket is the kind of strike zone for where I want you to be, because that's where you're going to get the benefits of the diversification and get the benefits of the concentration. This is why wealth advisors do this in your stock portfolio. This is why private equity companies do it in their funds. Okay. Okay. I want you to curate for asymmetry as you go out in the world to do this. So I want you to look for cash flow. I want you to look for operator edge. I want you to look for structural protection. Okay. And how you structure the deal, and the asymmetric return profile is ultimately what I'm always looking for, which is like, what's the sort of margin of safety here? What's the sort of track record? Am I making the right decisions at the right time? Okay. That's what I'm looking for. So if you have 12 holdings, okay, this is where meaningful diversification begins. If you have 24 holdings, this is where additional diversification adds zero benefit. Okay. So this captures the redwood style upside that we talked about with Kitses, and it avoids the over branching that the bushes have, right? So, I mean, think about, when you were when you were 23 years old and, you opened your first, 401k at work or whatever, and you put your $100 in, and then you put it in an index fund. How fast did that grow? Not fast, right? And this is exactly why. Okay. And so this is what builds a portfolio that compounds and protects. Guys, here's the 12 to 24 roadmap. This is it. All right. So just for this argument, okay, I'm not reverse engineering what you can afford or, what your portfolio should be, but I'm just saying, like, if you can cut a $50,000 minimum investment check, okay, try to target 2 to 4 new positions a year. Okay. And I want you to focus on a 5 to 10 year time horizon. 8 years plus or minus is actually the perfect amount of time that you need to grow to financial independence. Not kidding. If you're like, Walker, should I buy a business or not? Because like I have this really high paying job. I would say, you know what? It's a great opportunity, especially for those that like need to own their own business right now. But if you have golden handcuffs, okay, my advice is always like, look, take 8 years, build a private market portfolio, then peace out and go buy your business and do whatever you want. Because if you're sitting on a cash cow right now, okay, then you can actually build that asset that you own in this way without taking the concentrated risk of going all in with buying one acquisition and all of the operating risk that comes with that. I've done it multiple times. This is what I rock. But if you've never bought a business before and you are a really high paid person at a publicly traded company with you're getting stock options and all the rest of it. Roll that cash cow. Okay, you can build this passively while you do this. Okay. Then, after you do it over an 8-year period, you've got your outcome is 12 to 24 private market holdings in your own endowment style portfolio, in your own family office portfolio. Keep reinvesting those returns as they come and just allow it to compound over that first 8 years. And obviously, we've got a lot of great areas in our funds. I'm invested heavily in private credit, in oil and gas, in real estate, and in our private equity holdings. Okay. So sorry, breaking it down a little bit further. If you've got $50,000 each at 12 positions, you're talking about $600K. So if you can invest $600K over 10 years, great. This will get you there. If you can invest $50,000, if you can do 24 times $50,000, it's going to be 1.2 million. If it takes 10 years to do that, great. This is how you at least move forward. This is how you take that first step. Okay. And if you're looking for maximum risk return, I'd highly recommend looking at our private credit fund, which I firmly believe is actually a better engineered stock market and doesn't necessarily have a lot of those huge upside returns that some of our other things have. So it's a little sleepy, but if you're really looking for the single best risk return profile, anything I've ever seen, that's probably it. Okay. Putting that 50K 2 or 4 times a year. Yes. So basically you're looking at, question here. Are you saying that you put $50,000 2 to 4 times a year? Yes, I am. If all you have is $50,000, put it in something, like get going, right? That's my advice. Okay. Sorry, I can't give financial advice. We covered that in the disclaimer. This is what I would do. This is what I did. Okay. So ultimately it's like, if you can spread that money out, people say like, boy, I really like this. I really like this deal you're working on, Walker. Should I put double in that, or should I spread it around? I'm like, spread it around, because I don't know what's going to happen, but I love it too, or whatever. So like, we've got some really exciting opportunities, but ultimately it's all about adding a little bit of diversification. Go slow to go fast is what I always say. Okay. So just take that first step in to get going and build that portfolio. And look, let me just say this to you. Pick a number that you like. Okay. Say it's 12, say it's 15, say it's 20. Then divide by, say 8 years or 5 years, whatever you can afford. The thing is I've run this spreadsheet so many times, you cannot fast forward that first 5 years. You just can't, because you need that first cycle to occur. And then it's about mid-second cycle where all of a sudden the whole thing just like really clicks in, and financial freedom is really kind of engineered through a portfolio just like that. It's, I started investing just like this with discipline in 2019. In 2013, I started. In 2019, I was like, wait, something's wrong. I need to create a disciplined approach. And I did. And I started investing. I came up with an 8-year plan. I've already hit it, and now we're, hitting the rocket as we're, bringing in other investors along with the things that I'm investing in. Listen, since I'm talking about it, I know Natalie's here. Natalie, if you wouldn't mind just dropping in our data room link, our portal link, as well as contact information for our director of investor relations, just in case anyone wants to, look at what it is that we're doing, or, talk to Mike about, what might make sense for them. I have this theory, guys, like, why am I doing all of this? And ultimately it's like, if you've been paying attention to me, like, look, can I say this on the internet? I've made millions of dollars buying small businesses. Okay. And owning them and operating them and selling them. I've made millions doing that. It's a great playbook. Obviously I believe in it. But the thing is that like, when you get to this point where you realize like millionaires are stuck, because once you get there, you realize like, okay, that first million is so hard. It's so hard to get. Okay. And then once you go from there, trust me, it gets easier and easier. But like, once you get to that like $1 to $5 million mark, you start to realize there's a whole nother chasm that you have to cross. Okay. And the reason is because like, you are like, one 9/11, one tech bust, one real estate bust, one divorce, one lawsuit, one car accident away from no longer being rich. So I call it like little rich, right? And when I start to say like, well, okay, how much money, what's the criticism? Well, it's never enough, or whatever. Well, okay, sure. But like, what really would be enough? And what does the empirical evidence kind of suggest? Well, look, if you have $1 million, yeah, thank you, sir, or ma'am, it just says LinkedIn user. Appreciate your comment. So like, when it goes with 1 million, sorry, $1 million is a net worth is 8% of the US population. 13 million, I think it's 13.7 now because of inflation, is the top 1%. So if you have $13.1 million, you're in the top 1%. If you want to be in the top 1%, drop a 1 in the chat right now. Drop a 1 in the chat for me so I can see it, okay? Come on. If you don't put a 1 in the chat, then you either are already there or you should get off the call. Just, pro tip. Okay, but anyway, the point is, ultra high net worth is up here at 30 million. We talked about this earlier, right? And so ultimately, the thing that I want you to realize, this is the rich people. This is where all of the private market deals started targeting at the beginning. This is where they have been investing for decades, okay, for reasons that we already shared. And so ultimately, these are the people, whatever, I'll stop there. But the point that I want to make to you is, look, you're here, they're there, okay? Look, to go from 20 to 30 million, you can go to sleep and go from 20 to 30. That's like saying, hey, you have $200, can you get to $300? Like if I give you enough time, and you're like, yes, like it's, but the point is the stock market just moves too slowly. We cannot get to $30 million by investing, 10 or 20% of our, W-2 income into the stock market. It is too slow. It will not get you there. That's why entrepreneurs get rich and people with W-2s in the stock market don't, because the stock market doesn't work as hard as you do. All right. So how do we find that? So the point is can you get to 20? Okay. If you can bridge the gap from say 2 million to 20 million, that's the gap that I want all of us to cross together. Okay. And that's what Build Wealth is all about. And the point here is that if you want to be an ultra high net worth individual, okay, then you can't invest like the average millionaire. You just can't do it. Okay. All you need to do is look at all of the people that have money and how they're investing, and they're not doing it that way either. Okay. Let's see. Natalie dropped in. So we've got, you can call or text Mike Brown. He's my director of investor relations. He's there. There's his calendar and also our portal, buildwealth.investnext.com. Go in and, if you're a credit investor, go in and check out our deals, look at what it is that we're offering. Here's some projected IRRs of the deals I've been taking out. Okay. And I want to really clarify this, guys. This is, how do I say this? Sure, I'm a fund manager. Okay, sure. But this is what I'm trying to say. The origin story of this is that I wanted better access to deals and I wanted better terms to deals. And what I did was, after writing Buy Then Build and sending an email, M&A Weekly that goes out every Sunday to about 54,000 people for 7 years, one day I was like, hey, look, I know I'm the buying a businesses guy, but surprise, I also invest in real estate. This is my real estate team. I've got more money invested with them than anyone else. I love this deal. I'm putting, 50,000 of my own money in it right now. I'd be putting more if I was liquid at the moment. I'm not. And I'm just inviting my community to see if they want to come in. And full disclosure, if we fill the round, they're going to move my money from an LP to a GP, and I'll get a little extra returns for, raising all the capital for the deal. We needed 1.35 million, and we raised $4.5 million in 4 hours. And that's when I realized, oh my gosh, because the questions that people are always asking me was like, Walker, listen, I'm in Acquisition Lab. I read your book. What are you investing in? Like, where can I put my money? What are you buying? Can I get in that? And so I realized that there was this interest in joining me in what I was doing. Okay. And that's what Build Wealth is all about. Build Wealth is about, I'm going after sponsors of deals that I want to invest in, or I think I want to invest in. I'm reviewing the deal. I meet them. I say, listen, we're gonna raise like $5 million in like 6 weeks. Okay. There's gonna be one SPV. You don't have to deal with all these people, but I'm gonna come in and I'm gonna do pretty hardcore due diligence. And so I bring in my guy, formerly of Goldman Sachs, and we go through and usually we re-underwrite entire portfolios. Okay, to try to understand, what's happening in there. Then I get special terms. And those special terms do 2 things. One, it compensates me for my time and money that I put into the deal out of the sponsor's money, not my LP's money. And 2, it gets all of our LPs more money. It either gets them access at all or it gets them more money, okay, depending on whether it's something that they can access or not, okay? And I would say sometimes both, but if you can't get access to it, there's no, it's my deal. I'm creating the deal. Delphi is a perfect example. No one had access to that deal. But it was my personal relationships, the fact that I was the first investor in the company, that I went to the founder, after I knew where they were with the 007 video game. I knew it was fully developed. I knew, everything that had happened. And so we were able to bring it out to our investors and get some people in there. So this is just an example of the projected IRRs of a number of our funds, okay, if you have interest. So guys, listen, that's all I've got for you today. I really want to thank you for being here. We're at like 50 minutes. Listen, all I can say is that, like, if this is something that, you're interested in learning more about, drop a 1 in the chat. I want to see you. I'll connect with you. We can DM or whatever. Reach out to Mike, check out what we're doing. Sign up for WealthStack Weekly. It's completely free. And ultimately, guys, it's all about, how do we build our own family office together? How do we get access to the deals that that was always reserved for people that were way richer than us, so that we can also benefit, so that our cash can be working as hard as we do. All right, guys, thanks so much for being here. See you on the next one.